silver to $100, not because of speculation, not because of hype, but because a single policy decision quietly broke a system that had held together for decades. Factories didn't panic first, banks didn't either. The shock began somewhere deeper, inside supply chains that suddenly stopped working. What happens when the metal behind solar panels, electric vehicles, medical systems, and global infrastructure becomes unreachable? Not expensive, but unavailable. This is not a story about prices. It's a story about access, about power, and about what breaks when paper promises collide with physical reality. Welcome to Boring Currency Ledger. If you believe markets should be understood, not followed, and if you still value calm, rational thinking over noise and panic, then consider subscribing, not out of excitement, but out of responsibility, the way people used to do things. And before we begin, tell us something simple in the comments. Where in the world are you watching from today? The story did not begin in a mine, a factory, or a trading floor. It began with a policy decision that most people first saw as political theater. When new tariffs were announced, public discussion focused on politics, trade balances, and headlines. Markets reacted in familiar ways. Stocks moved, currencies adjusted, experts debated winners and losers. But beneath the surface, something more serious had already started. Tariffs are often described as simple taxes. In reality, they act like pressure points. They do not just raise costs. They force companies to change behavior. They disrupt where goods are made, how fast they move, and who controls supply. For businesses built on global supply chains, tariffs do not arrive slowly. They arrive all at once. At first, silver was not mentioned. Most analysts assumed the damage would stay limited to finished products. Solar panels might cost more. Electric vehicles could face delays. Electronics companies might see smaller margins. These effects seemed manageable, even temporary. What was missed was the difference between a trade dispute and a structural break. The tariffs hit countries that sat at the center of global manufacturing. These were not just assembly hubs. They controlled key components and materials far upstream. When those links were strained, downstream industries faced a new reality. They still had to produce, but the materials they depended on were no longer guaranteed. Silver entered the story quietly. Unlike oil or steel, silver rarely attracts attention. Yet it sits inside nearly every technology modern economies rely on. Solar panels use it to move electricity efficiently. Electric vehicles depend on it for control systems and power management. Medical equipment, data centers, and communication networks all rely on it in small but critical amounts. Silver demand is not driven by desire. It is driven by necessity. As tariffs forced companies to move away from established suppliers, manufacturers discovered they could relocate factories, but they could not redesign physics. The metal inside their products could not be easily replaced. In many cases, it could not be replaced at all. At first, companies treated the problem as temporary. They expected new suppliers to appear. They believed inventories would cover the gap. This thinking was based on a world where trade flowed freely and buffers always existed. That world had changed. For decades, silver moved smoothly through global markets. Mining output was stable. Warehouses were full. Paper contracts masked shortages. Few questioned whether the metal was truly available because it always had been. Tariffs changed that balance. As companies rushed to rebuild supply chains at the same time, demand did not just rise, it accelerated. Orders planned over years were pulled into months. Safety stocks grew. What looked cautious at the company level became strain at the system level. This did not show up on price charts immediately. Financial markets react to headlines. Industrial markets react to delivery failures. The first warning signs appeared in places most investors never watch. Warehouse withdrawals increased. Delivery times stretched. Physical premiums rose quietly above quoted prices. The mistake was treating tariffs as a pricing issue. They were not. They were a coordination shock. By forcing many industries to act at once, tariffs exposed how little slack existed in the system. A material that seemed abundant under normal conditions became scarce very quickly. By the time silver prices began to move, the real shift had already happened. The market was no longer asking what silver should cost. It was beginning to ask who would get it at all. That question would not go away. The problem did not reveal itself through headlines or price alerts. It revealed itself in design rooms, engineering meetings, and factory planning sessions. While markets debated tariffs, engineers faced a much harder question. How do you build modern technology without the one metal it depends on? They already knew the answer. Silver is not used because it is cheap. It is used because it works. It conducts electricity better than any other metal. It resists corrosion. It performs reliably under heat, pressure, and constant use. In many systems, it is not chosen. It is required. This is where many outside the industrial world misunderstand the situation. When prices rise for oil or steel, companies look for alternatives. They switch materials, redesign components, or delay projects. With silver, those options are limited. There is no substitute that performs the same job at the same scale. Copper conducts electricity, but not as efficiently. Aluminum is lighter but less reliable. New materials exist in laboratories, but not in mass production. For industries built on precision and safety, compromise is not acceptable. Solar panels provide the clearest example. Each panel uses a small amount of silver to move electricity efficiently across its surface. Reduce the silver and efficiency drops. Performance falls. Warranty risks increase. When governments mandate renewable energy targets, manufacturers cannot simply redesign panels overnight. They must meet standards that already assume silver use. Electric vehicles face the same reality. Every electric vehicle contains silver across its power systems, control units, sensors, and charging components. These are not luxury features, they are core functions. Without silver, vehicles become less reliable and less safe. In an industry already operating on thin margins, failures are not an option. What makes this situation dangerous is not just demand, it is demand timing. For years, silver demand grew steadily. Supply could keep pace because growth was predictable. Mining output adjusted slowly. Recycling filled small gaps. Inventories provided balance. The system worked because pressure was spread out. Tariffs changed the timeline. Suddenly, industries were no longer planning gradual expansion. They were planning emergency relocation. Factories that were once overseas needed to be rebuilt domestically. Supply chains that once stretched across continents needed to be shortened quickly. All of this required materials immediately, not over decades. Silver demand did not just increase, it stacked. Solar, electric vehicles, electronics, medical devices, grid infrastructure, and communications all pulled from the same pool at the same time. Each industry acted rationally on its own. Together, they created a problem no one had modeled properly. Recycling could not solve it. Silver used in solar panels and vehicles is locked away for decades. It cannot be recovered quickly. Electronics recycling recovers some silver, but the process is slow, expensive, and inefficient at low prices. Even when prices rise, recycling takes time to scale. Collection systems, processing capacity, and economics do not change overnight. Mining could not respond either. Most silver is not mined on its own. It is produced as a byproduct of other metals like copper and zinc. Those mines do not increase output just because silver prices rise. Their decisions depend on their primary metal markets. Pure silver mines are rare, and developing new ones takes many years due to permits, financing, and infrastructure. This created a structural mismatch. Demand was immediate and inflexible. Supply was slow and rigid. Businesses began to realize that price was no longer the main risk. Access was. A factory cannot operate without silver, regardless of how strong demand is for its products. A contract means little if delivery cannot be guaranteed. For the first time in decades, procurement managers started to think less like buyers and more like strategists. Some companies paid higher prices. Others accepted long delivery times. The most cautious began exploring direct supply. For decades, the silver market operated on trust rather than inspection. Most participants never asked where the metal was. They only cared that the contract said it existed. This worked because very few people ever demanded delivery. Silver was traded, priced, hedged, and settled almost entirely on paper. That assumption quietly failed. The modern silver market is built on representations, futures contracts, unallocated accounts, exchange-traded products, and leasing agreements all promise exposure to silver without requiring possession of it. Under normal conditions, the system appears efficient. It provides liquidity, smooth pricing, and flexibility for investors and institutions. But efficiency depends on one fragile condition. Physical demand must remain limited. When industrial users began requesting actual metal instead of financial exposure, the system was tested in a way it had never been before. Warehouses that once seemed full were suddenly treated as critical infrastructure. Inventory reports, previously ignored, became essential reading. The numbers told an uncomfortable story. Large exchanges such as COMEX showed rapid inventory withdrawals. These were not speculative traders taking profits. These were manufacturers, refiners, and institutions removing silver because they needed it outside the financial system. Each withdrawal reduced the buffer that paper markets depended on. At the same time, the number of paper claims remained unchanged. This created a growing imbalance. Industrial demand changed that assumption. Manufacturers cannot accept cash settlement when they need metal to keep factories running. A solar panel producer cannot install a futures contract on a rooftop. An electronics manufacturer cannot solder with a promise. When delivery matters, paper loses its advantage. As physical silver became harder to source, premiums began to rise. These premiums were not reflected in official prices. Spot prices remained anchored to paper trading activity, while real-world transactions occurred above those levels. This divergence signaled a breakdown in price discovery. The market was no longer speaking with one voice. In London, similar stress emerged within the London Bullion Market Association system. Unallocated accounts, long treated as safe and liquid, came under scrutiny. Clients began asking whether their silver was truly there, or whether it had been lent, leased, or promised elsewhere. In many cases, it had. This was not fraud. It was structure. The system was designed for efficiency, not resilience. Silver was reused within the financial system multiple times, with the assumption that physical demand would remain secondary. When that assumption failed, so did confidence. Banks faced a difficult choice. They could attempt to source physical silver at rising prices, absorbing losses, or they could delay delivery, renegotiate terms, or invoke legal protections. None of these options inspired trust. Each response reinforced the same conclusion. There was not enough metal to satisfy all claims. Margin requirements were raised to control volatility. This move was intended to reduce speculation. Instead, it exposed the divide between financial players and industrial users. Speculators sold. Industrial buyers stepped in. Physical demand absorbed selling pressure almost immediately.